Good morning, everybody. We have a lot of interesting things to get to today, but I want to start first down memory lane. I'm going to take you back 27 years to 1998 and a hedge fund actually, called Long-Term Capital Management. Who are these guys? Well, back in the day, this was the hedge fund of hedge funds. It was full of Nobel Prize laureates who had these models that no one had ever seen before, and there was no way you could lose with these guys, and the money poured in. Banks poured their money in, and long-term capital management packaged up their investments, sent them back to the bank. They were levered up, and money went and investments went out to all of these people, and they all thought they had it made. Well, then what happened? Long-term capital management got on the wrong side of all things, the Russian ruble currency and what we call the Asian tigers. Vietnam, Thailand, Singapore, these guys were going to ascend forever. They cratered, the ruble cratered, and none of their models saw this coming. And the whole thing went boom. So why do we care? Well, what happened was that connection between that one hedge fund and the banks threatened the entire system. And I had a friend back then. His name was Miles Gordon. He was actually the head of Financial Network. He was the representative for the independent advisors across the United States. He got a call on a Saturday afternoon, I think, that said, Miles, we need you in New York City, maybe it was Washington, D.C., one of the two, tomorrow morning at 10 o'clock. Why? We've got an emergency. He flew from California back to the East Coast, entered the room, and there's the head of Goldman Sachs, J.P. Morgan, Bank of America, the SEC, FINRA, all the alphabet agencies. And they said, long-term capital management has blown up. This thing is going to cascade through the entire banking system. And if we don't backstop this, if we don't put in capital today, this thing is going to be a disaster tomorrow morning. Well, everybody ponied up. Goldman, JP, Wells Fargo, all of them, except two. Lehman Brothers said, hey, this ain't our problem. Bear Stearns said the same thing. We had nothing to do with this, and they walked out the door. Everybody else backstopped long-term capital management and prevented a disaster. By the way, interesting side note here. What happened 8 years later? Remember when Bear Stearns went down in January of 2008? No one came to their rescue. And what happened to Lehman in September of that same year? Down she went. So if you think it's not personal, even at that level, yeah, it is. So why am I bringing this up? Well, the term we now have for this marriage between hedge funds and banks is the shadow banking system. It's money that moves behind the scenes. It's loans that are made on investments you and I have never heard of. And it is big money, and it is repackaged up at the hedge fund level and sent up to the banks and resold and repackaged. Fees are taken out everywhere. It is very profitable for everybody until it isn't. Now let's talk a little bit about hedge fund models and why I'm bringing this up. What is the incentive for hedge funds? How do they get paid? Well, it's pretty easy. They call it the 220 model. Let's say you put your money with a traditional hedge fund. And by the way, the reason you do this is because they're so smart. They're the smartest guys in the room. They've got connections you and I will never have, blah, blah, blah. Right? 2 and 20. They get 2% right up front for all the money under management. And then they get 20% of the profits. All right, so what's the incentive? The incentive is swing for the fences, baby. Because if we make a big amount of money, we get 20% of that. If we lose, at least we still got the 2%, and we can at least feed our families. Well, all right, what's happening today? You would think after long-term capital management and Lehman and Bear Stearns and all these things we've gone through over the last 2 decades, that maybe we'd be tightening up on this shadow banking system, that we might have some visibility into what they're doing so we can see the systemic risks. None of that has happened. In fact, the opposite. If anything, it's more opaque and global than ever. Why am I bringing this up today? It's because of what happened a month ago. What we saw when President Trump kicked off the tariffs, we saw all kinds of volatility in the stock market, right? Right off the bat. There were some days the Dow fell 5% in a day. That's a pretty big drop. The banking stocks, on those days. If the market fell 5%, the banking stocks were down 10. Uh-oh. Something's going on that was disproportionate to what the risk they show on their balance sheets versus maybe what's in the shadow banking system. So please know this. Walt and I are pretty aware of all this. We're keeping up with it. Now, what you would think is, well, let's go to safe investments. It used to be the banks were safe. What if they're not? Where will people go? Well, historically, they go to things that they think are more solid. The stuff actually you're in. Well, you got to eat, you got to have water, you got to have steel, you got to have, gold, silver, been around forever. This kind of thinking. And this is what we also saw in the markets. The markets fell, they're barely coming back. Gold and silver initially fell much less. So did the commodities. They fell, but much less, and are now ahead. There's a great rotation going on over to what is perceived as safety. So please do not have more than $250,000 in any one bank. You're not insured above and beyond that. And the new rules don't expect bailouts. And please be aware again. We're watching out for you. And with that, I'll turn it over to Walt.